Hi there. In this video, we'll explain important pension withdrawal developments and their potential tax implications in 2026.
Welcome to this explainer. If you're a UK taxpayer eyeing retirement, the rules are changing right under your feet. To help make sense of it all, let me introduce My Tax Accountant, or MTA. They're a brilliant UK accounting firm that helps businesses and individuals navigate tricky tax compliance and HMRC regulations. Today's explainer was put together by their top tax advisors, and we're looking at a huge topic. Critical June 2026 changes to pension withdrawal rules every taxpayer must know in the UK. Let's get straight into it. So I want you to imagine this scenario. You're a UK PAE earner, you're in your 50s, retirement is finally on the horizon, and you decide, hey, I'm gonna take a small, completely harmless withdrawal from my pension pot. Maybe it's for a home improvement or just a one-off expense. Well, what if I told you that one minor move could permanently lock you into a massively worse tax position for the rest of your life? Sounds crazy, right? But unfortunately, under the new rules rolling out, this is a very real compliance trap. It's something a lot of people only figure out when it's way too late to fix. And that is exactly why getting a handle on the 2026 and 2027 tax landscape is absolutely crucial for your financial future. Because these new regulations are so incredibly dense, MTA provides expert guidance specifically tailored for this 2026 and 2027 transition period. Look, the landscape is shifting rapidly, and making sense of all the jargon and deadlines takes a really focused approach. Our goal today isn't to cause panic, definitely not. It's to replace that confusion with absolute clarity and a tactical plan. That way you can properly protect your wealth and make decisions with total confidence. Here's our quick roadmap for today. 1. Navigating the TT-AFAC trap. 2. Overseas pensions and recoupment. 3. The low earner windfall. 4. DB and CDC changes. 5. Practical planning. And 6. Summary. All right, let's kick off with Section 1, Navigating the TT-FBA's trap and understanding your baseline. Okay, so remember when the government completely scrapped the lifetime allowance, the LTA, back in April 2024? Well, they brought in a whole new system of allowances. And to bridge the gap between the old system and the new one, HMRC uses a default mechanism. It's called the Standard Transitional Calculation, or STC. Now, here's how it actually affects you. If you touched your pension at all before April 2024, HMRC automatically assumes you took the absolute maximum 25% tax-free cash against a very specific historical limit. And that baseline number is exactly £1,073,100. The legislative formula behind this change really highlights the problem. Let's say you historically took way less than your 25% tax-free cash entitlement. Maybe you were in a defined benefit scheme, a final salary scheme, which used to offer really poor commutation rates. Basically, giving up your guaranteed pension income for a lump sum just didn't make financial sense back then. Or maybe you just chose to leave your pot alone for later. Well, in those really common scenarios, this default math actually works against you. It artificially suppresses your remaining lump sum allowance today. It effectively pretends you took a massive chunk of tax-free cash that you never ever actually received. So the absolutely crucial thing here is knowing you have an alternative. You do not have to just accept that default STC. Instead, you have the legal right to apply for a transitional tax-free amount certificate. We just call it a TTFAC for short. Think of this certificate as your official proof of history. It lets you evidence the actual lower amount of tax-free cash you received in the past, rather than relying on HMRC's assumed maximums. By proving you took less cash historically, you shield and protect the rest of your tax-free allowances so you can actually use them today and in the future. And here is a massive professional tip from the MTA team. Literally, do not trigger a benefit crystallization event before you've checked your TT-FAC eligibility. I can't stress this enough. This is where so many taxpayers get tripped up, and one mistake can be devastating. Applying for a TT-FAC is a binary, irreversible decision. It has to be executed completely before you make your very first post-April 2024 withdrawal. If you take even a single penny of tax-free cash under the new rules without this certificate securely in place, boom, you are legally locked into that default STC forever. 0 second chances. And on the flip side, once a TT-FAC is issued, you can't revoke it, even if you later realize the default would have been better. So you absolutely have to do the math first before making a move. Moving on to Section 2, Overseas pensions and recoupment, and those critical June 29 deadlines. Looking at the statutory timeline, the final corrective technical framework laid down by the Treasury kicks into super high gear on exactly June 29, 2026. Circle that date. It's really vital to understand that this isn't just back office administrative housekeeping. This is a foundational shift in how your private wealth is managed, reported, and protected across borders. Let's look at how this plays out in the real world. From June 29, 2026, any standalone lump sum paid to you from an overseas pension scheme is now going to be explicitly tested against your internal UK allowances. Your global wealth extraction is now legally tethered to domestic UK limits. But wait, there's also a massive shift in power when it comes to accidental overpayments. Previously, if a pension scheme messed up and overpaid you, they usually had to go get a county court order, a formal legal mandate, just to reduce your future payments to claw that money back. As of June 29, that vital protection is totally gone. The pensions ombudsman can now authorize that recoupment directly. Their ruling is what we call self-executing. It acts exactly like a court order. Because of this, taxpayers now have to aggressively present any defenses, like if you already spent the money in good faith, which legally is a change of position, directly to the ombudsman, because their word is now final. All right, Section 3, the low earner windfall, and how they're correcting the net pay anomaly. For years, there's been this really frustrating structural anomaly in the UK tax system right around the £12,570 personal allowance threshold. If you were earning right around this mark and you paid into a workplace pension through a net pay arrangement with your employer, you unfairly missed out on the 20% basic rate tax top-up. Meanwhile, someone earning the exact same amount but in a relief at source scheme got that top-up automatically. It created a really systemic unfairness for lower earners across the whole country. So, to permanently fix this, the government is introducing the Low Earners Pension Payment. We just call it the LEP. This payment finally ensures equal, fair financial outcomes no matter what specific type of scheme your employer happened to choose. And honestly, the best part of this fix is that it is entirely automated. Employers don't have to rewrite their complex payroll software, and individuals don't need to fill out a mountain of application forms. HMRC actually assesses this retrospectively for every single tax year from 2024/25 onwards. It ensures eligible earners finally get the money they're owed without lifting a finger. Did you know HMRC is going to directly contact around 1 million eligible individuals about this starting in August 2026? Because it's all automated, you don't have to actively apply. But, and this is a big but, it creates a secondary issue. Because HMRC is suddenly reaching out to 1 million people about cash they're owed, there is a huge fraud risk. Scammers are absolutely going to try and take advantage of the confusion. So please remember, genuine HMRC correspondents will never, ever ask for an urgent bank transfer, your personal PIN codes, or your passwords. Always verify any communication independently. Next up, Section 4, Structural Changes regarding DB surpluses and CDC transfers. There are two monumental structural shifts hitting occupational schemes this summer. First, a major government consultation wraps up on September 2nd. It proposes allowing defined benefit schemes to safely release billions of pounds in trapped surplus capital back to sponsors. But to do this, the scheme has to be funded to a highly secure, low-dependency basis. That just means the scheme holds enough low-risk assets to confidently pay out all promised pensions without needing to rely on the employer for future cash. Second, starting July 31st, new regulations allow the bulk transfer of standard defined contribution benefits into collective defined contribution, or CDC schemes. And here's the kicker. This can happen without requiring explicit member consent. The whole landscape of UK occupational pensions is centralizing fast, and it's taking a lot of individual decision-making out of the equation. All right, Section 5. Let's get into the practical planning and your action plan. If you are that PAE earner in your 50s we talked about at the start, right on the cusp of making huge retirement decisions, here is your definitive defensive playbook. Step 1. You must do a strict mathematical audit of any pension withdrawals you made before April 2024. Dig up the records. Step 2. Run the actual numbers on applying for a TTFAC versus relying on the default STC outcome, and do this before you take even one single new withdrawal. Step 3. Reevaluate your overseas portfolios or pension transfers right now, because international payouts are aggressively counting against your domestic allowances. And Step 4. If you're getting an occupational pension, watch your monthly payments like a hawk. Your traditional legal shield against sudden overpayment recovery has been totally dismantled by the new Ombudsman rules. Finally, Section 6, Summary and Next Steps. Look, the summer of 2026 is going to be an incredibly busy and consequential time for UK tax compliance. Let's just do a quick recap of the timeline. On June 29, the rigorous overseas pension rules and the new ombudsman recoupment powers go fully live. Fast forward to July 31, and sweeping CDC bulk transfers become legally permitted. Then in August, the low earners windfall officially rolls out, putting money back into the pockets of 1 million workers. And finally, on September 2nd, the window closes on shaping the future of DB surplus extraction. It is a packed few months. The UK government is clearly building a highly transparent, tightly monitored, and very centralized pension system. Because applying these exact rules correctly depends entirely on your own employment history and your past withdrawals, remember that this explainer is strictly for general guidance only. You really should obtain professional advice before making any serious financial decisions. Please do not leave your retirement allowances up to a default HMRC calculation. Contact the expert team at My Tax Accountant today to lock in a personalized tax strategy. And I'll leave you with this final thought. Will your retirement be defined by the hidden tax traps of 2026 or by the tactical planning you put in place today? Thanks so much for joining me.